Hey folks, it's Mark Montfort here for Redbelly Insights episode 7. In this one, we have a treat because just like lucky number 7, we are honored to be able to have our very own CEO, Alan Burt, in for a fireside chat. He is talking to Michael Prendiville of JellyC. We'll learn more about what they're up to, how they're tokenizing their fund, and a whole lot more. You would have seen that Alan joined us for the AMA just a few weeks ago, and now we have him here for this fireside chat. What a treat. More in store. Check it out here.
Thanks, Mark, for the kind intro. Obviously, I'm Alan Burt, the chairman of Redbelly Network, and I'm really excited today to be joined by my absolute favourite partner and investor, Michael from JellyC. Thanks for joining us, Michael. I describe you publicly and privately as my TradFi degen, and I know you kind of cringe sometimes when I say that, but it's very rare in this space to get someone who both understands TradFi and has heaps of experience there and can see not just the opportunity in the asset class, but also how the technology is transformational. And that's why I think from our perspective, the partnership that Redbelly has with JellyC is really exciting, not just as an investor, but as someone who's going on a journey of transformation as you see it as asset managers into the future. So I'm really excited to chat with you today about what you think about the space, where you think it's going, what you're doing about it on the way through. So welcome. Do you want to kick off with a little bit of background about yourself and how you arrived here in digital assets?
Well, let me start, Alan, by saying thanks very much for having me on the podcast. Redbelly is a community that I admire, and everything that the Redbelly Network are doing, we like to stay closely in contact. So it's good to be on the chat, and good to be chatting with yourself. In terms of how I got into the space, really on the TradFi side, I came from a banking background, started here in Australia with ANZ, moved up to Singapore, ran the dealing room up in Singapore for Asia on the currency and commodity side, and then moved over to London to run the proprietary side for ANZ. Ended up back in Asia doing proprietary really for Standard Chartered. And it was around 2012 that I decided there were bigger things ahead. So I came back to Australia, started a hedge fund out of the Cayman Islands. The investment management business was here in Australia. Did that for a number of years. It was a currency and fixed income strategy, and that ticked along nicely. But somewhere in the mix of all that happening was a burgeoning volatile asset class in crypto, especially in Bitcoin. And I think it really came to a head probably 2017, 2018, when TradFi, the volatility on the traditional side was really compressing, and the interest rates were close to zero. And it was a grind. And, for myself personally, I had pretty much all of my money, save the house and a few other assets, all in the fund. And for me to return like we'd been returning in the previous, 5 years, I was going to have to open the shoulders and really risk a lot of it. Okay, so to return, say, somewhere between 12 and 15% with zero interest rates and next to zero volatility, or euro volatility was under 5, it was a big ask. Okay, so I saw Bitcoin out of the corner of my eye, and had been watching it closely ever since Paul Tudor Jones had said it's on his radar, and it was around $750 at that point. And I started dabbling in it in Bitcoin on a PA perspective, and look, one thing led to another. It dragged me down the rabbit hole, and I ended up handing back the money on the hedge fund that I was running and going holistically into the sector. So that's kind of that's how I got involved. It wasn't until Ash Cooper, rest his fantastic soul, tapped me on the shoulder and we started up JellyC in 2021. So it's been a fantastic ride since then, and there's lots going on. Could not. Everything that's happened in my career has been leading up to these next 12 to 18 months.
Amazing. You describe that as a grind, and I'm taking that means that where you find yourself now, with plenty of volatility as a feature, not a bug in your mind, is exciting and not grinding. And you mentioned Ash as the one of the founders that we lost recently, unfortunately. He was who kind of spurred you on to say let's do this thing. Yeah,
he's a great man. We miss him a lot, and what I would say is part of the vision of JellyC has come from the great man himself. So he was a big advocate of us having liquid strategies, and we have 3 liquid funds. One's the Blue Bottle Bitcoin Plus, so I'm targeting 10% over Bitcoin through safe custody. Another one is infrastructure fund that's investing in the best networks. And then a market neutral fund, which is consistent yield and very little volatility. He was a big advocate of running that as a portfolio, like your 60-40 in TradFi. So you've got the 60-40 in TradFi, 60% equities, 40% fixed income. What we're doing is that 60 is made up by 30 in the Bitcoin Plus, 30 in the infrastructure fund, and then we have 40 in the market neutral. And it rotates not on a monthly basis like the MSCI, but it rotates on a optimized basis. Okay, we're in the new era, so optimization can, take in, many formats. One can be time, one can be threshold. We have a mixture of both.
So when you say rotate, you've got like a basket over the top of that between those strategies, or
no,
are in the one?
I'll give you that's a good question. So I'll give you an example of, for instance, how the MSCI rotates on a monthly basis on the traditional side. So let's say their equities, go up, and instead of it being 60-40 equities are now 70 relative to, the fixed income side, which is 30. What will happen on a monthly basis, it'll sell down that 70, so it's rebalanced at 60, and the fixed income side will come back up to 40. So they'll buy that and they'll sell that. Okay, the same thing happens. Okay, let's say we've got our long only, Blue Bottle Bitcoin Plus and the infrastructure side, and let's say the market is rising, and that becomes 70% relative to, the market neutral, which is now only 30. We'll sell down that and buy that. Okay, and it rebalances, but not on a monthly basis. It rebalances on a optimized basis.
Amazing. Well, I guess is the beauty of working with highly liquid assets, right? In a different market where you can rebalance across a kind of asset classes, not just. I know it's all in the kind of digital asset space, but effectively what you're talking about is what would be, as you said, kind of fixed income versus equities versus properties in your terms of the strategy, right? Amazing.
Exactly. And so that's Ash's strategy. He really wanted to do that because it's a strategy which you can enter at any point in time.
Makes sense.
It's going to suppress the downswings. There'll be a little bit of suppression on the move ups. But what it'll do is it'll always generate a yield, and like a cork underwater, it should always sort of keep popping its head up.
I like that.
So over time, that's what it should do.
I assume you put that in a cork over time.
And it takes advantage of the volatility as well.
Yeah,
in the sector.
I think that when people talk about the sector being risky, it's only risky if you're not kind of managing that risk, right? It's that is, to your point, a trading opportunity to make money if you're looking at it the right way, which is why I think some people kind of see volatility as a real problem for the space, whereas you actually managing that volatility the right way.
We love the volatility. That's right. I love the volatility, and it's the reason why I got out of the traditional side. Really, it doesn't matter whether something goes up or down. It's a matter of if there's volatility, we can make money out of it. But in this instance, our thesis is obviously that every transaction will end up, or a great percentage of the transactions will end up going through the blockchain. So that thesis has us having a long-only component of not only Bitcoin through the Bitcoin Plus fund, but through the infrastructure fund.
Really interesting. I think that kind of leads me naturally to be thinking about like a productized trade strategy. Think like Athena or some of these other Multiply or others where they're hedging out one side of the trade or balancing the risk. In fact, now you've got not Athena just productizing a trade, but adding real world assets to that, basically making it a hedge fund, if you will, or at least a thesis or fund structure. What do you see spilling over, I guess, more broadly to what you do and the opportunity or not in terms of how your funds are positioned or work in the future?
Alan, you have hit the nail on the head, mate. Athena is where it's at. In fact, our market neutral fund is Athena for Australia.
All right.
Okay,
cool.
so we take traditional finance, so you can call it tokenized bonds, tokenized deposits, etc. And we're investing in that space, and we're also taking the yields from crypto. So let's say, for instance, basis or funding on the crypto side, or for instance, cross-exchange arbitrage is showing us a yield greater than the traditional finance side, then we're taking that yield. Okay, if that yield, for instance, in the down moves in crypto, that move can compress to zero or can even go negative, then we're out. We're on the traditional finance side. Okay, so we're taking the best of both worlds and we're returning that yield to investors. That's what we're doing on the fund basis at the moment. So we've just moved that particular fund from monthly liquidity down to daily liquidity. And with the help of Redbelly and Liquidize, we're looking to tokenize that. So I'll lead into what that means. That means being able to go in and out of the fund 24/7 with one click of the button. And, that type of functionality, with safe custody, because we will have solved that in the background, is really the end game.
And do you see opportunity to take that on to be collateral in other places as well? I think, when I think about securities, I think I read that something like only 11% of the world's securities are available as collateral. Obviously have a liquidity profile, if you will, that make people comfortable to accept it as collateral. And so to me, that's a massive opportunity if we think about bringing, particularly in the real world asset space, kind of changing the approach to liquidity as it relates to any of these instruments, does then open up that opportunity. Are you guys thinking about that at all?
Absolutely. There's a lot to solve before we get to that point. So you can imagine solving liquidity 24/7 and all the ins and outs of that. Let's say, for instance, we want to, let's say we're talking about our Athena product, our market neutral at this point, and someone wants to deal in and out in a large size over the weekend. Let's say we have that fund invested just theoretically in tokenized deposits. We need institutions to support that side. Okay, and we are working hard in the background with Franklin Templeton to solve this. Okay, so I would envisage that by the end of the year, we will have that solved. Okay, so there's a lot of steps. So we solve that, we become 24/7 in size because it's not going to work if we don't have capacity. Okay, and then once we've done that and we've automated this strategy, so automated the entry, automated the exit, so there's no longer any manual, execution. Okay, then when we've got to that point, the next step after that is to be able to use our fund as collateral for other investments, i.e., you go long our strategy and you're earning a yield out of the Athena type product. And then, for instance, you use some of that to buy Bitcoin or, buy the Bitcoin Plus or buy Redbelly.
We love that idea.
Yes, exactly.
I think that's interesting because you also talked a moment ago about traditional finance and crypto in terms of playing the best of both worlds. Is that, I think we still have two buckets, right? But are we actually talking there around, imagine everything's now tokenized. Are we now just talking about, just different assets and different funding costs at different parts of the cycle, like kind of uncorrelated assets more than TradFi v DeFi, and you being able to move your strategy around between of them? Or is there something more intrinsic about the two systems, like kind of what Michael Saylor's doing as well?
No, I definitely think the two will spill over. Okay, and we're on that journey at the moment where, let me take it back a step, 2021, 2022, I wasn't 100% sure. Even though I was entering this space, I was entering it because of the volatility. But I wasn't exactly sure that the endpoint, there was going to be a spillover, a crossover between traditional finance and, crypto. I could see the potential in crypto. Now it is absolutely definitive that there is going to be the crossover, and the integration is happening right now. The first step of that integration is the Stablecoin Act over in the US, and from that point, everything else flows. But that will unlock everything, and that will unlock all of the other jurisdictions. So it is a massive, the Genius Act is a massive point in time for everything in terms of that interoperability. Okay, and that's happening. You can see the probabilities of that happening by the end of 2025 on poly markets are now up around 86%. Okay, it is going to happen. Thank God that Donald Pump has come in, because he's really helping us realize everything that should be realized. Like the new world order in terms of blockchain underpinning everything. So, it's exciting times. It's just, I can see the steps. It is just a matter of it unfolding. And in Australia, it won't unfold until the Digital Act is passed. But there'll be, we've already seen Andrew Charlton and the Labor Party, they've already outlined that they are definitively positive on, getting a Digital Act passed. What the timing is, it's hard to tell, but I would expect somewhere middle of next year for that to be passed, and then kaboom, we're on.
Nothing like some strategic competition to kind of progress things, huh? Like when we were in New York for the Digital Asset Summit, and that was literally just as weeks into Trump's administration, and he addressed the conference and kind of set the scene. And I think it was quite interesting that basically America hadn't really been doing anything from a TradFi perspective. It was like that on the don't touch this, that literally nothing had progressed. And literally in the 3 months watching America come to life in the opportunity and doing what only America can do in terms of innovation and capital markets has been impressive. So I think to your point, by the end of this year with that regulatory overlay is going to be amazing. In terms of stable coins and their role, are you thinking about that as payments technology or settlements technology from the kind of core importance that you're describing here?
Alan, thanks for asking that question, because JellyC has a strategic investment into a stablecoin venture called Katina Digital. And so I feel like that is something which we would like to communicate to everybody, to your community. Both. We see it as a merchant transactions. We also see it as more extensive tokenization transactions and underpinning the real world assets. So eventually, I think the Redbelly network could see a lot of transactions going through, not just to buy your coffee at the local merchant down the street, but also a transaction that Big Super, Aussie Super does, buying international equities, and it settles atomically or instantaneously with no counterparty risk. The whole thing just makes a hell of a lot of sense. We're driving hard. We want to be a regulated stablecoin issuer. We're working with ASIC at the moment, or at least Katina is. We want to help facilitate it so everyone in Australia benefits. You're not paying that 25 cents on your coffee. You're paying 1 cent, if that. Okay, and the merchant's getting it straight away. Likewise, for instance, when we do a FX transaction with one of our funds, let's say we get a new subscription into one of our Cayman's funds, from an Australian, it takes us 5 days to get the payment there, to get it into our bank account and then deploy it. You can imagine having a Aussie stable coin, which is very liquid, interbank rates, converting it into, for instance, USDC, and then putting it to work instantaneously. Okay, so when we talk about tokenization, we absolutely have to have, here in Australia, we have to have a liquid and a trustworthy stablecoin, and that's what Katina Digital is trying to do. Yeah. And we're hoping that it will be especially active on Redbelly because lots of great things are happening on Redbelly, Project Acacia, etc. So, we see this is how it's going to unfold in Australia through Redbelly.
We certainly share that optimism and view. There's a whole other podcast I think with Drew and Rob on stablecoins, which we must get to. Just circling back on even your example there of Aussie Super. For the people who don't know, is a superannuation in Australia is a $4.23 trillion asset class that kind of grows at 12% per annum. That's just on new capital flow, right? Let alone that's of people's wages. But that example you just made, where they're making a trade on US equities instantly, it makes me think of something. Obviously you've probably seen Kraken are in the process of launching equities on their exchange.
Yeah.
What are you thinking or seeing? Because again, this comes back to this: is it a convergence? Is it a flippening? Is it actually deregulation, not regulation? Like what are we seeing play out here when crypto exchanges or digital native asset venues start providing instruments that are available via other distribution methods? Is this a distribution play? Is this, so is it an access to markets perspective? Are we going to see better or different price formation? How do you think this plays out between the traditional venues and digital asset venues as it relates to distribution flow, volume, and kind of ownership of that market? Or is it markets of markets? I mean, what are you seeing there?
Yeah, I think it's a race. You had, for instance, Interactive Brokers, which was probably one of the first brokers that discounted, really discounted commissions, gave you access to global asset classes. Okay, Interactive Brokers is bound by the traditional, rails. Mm-hmm. Okay, we are at the next phase where investors want 24/7 access. And they want to be able to also utilize some of the benefits of the crypto industry, which is, for instance, generating a yield from market making, through AMMs. We won't go into the details, but traditionally the market makers on the traditional finance side, whether it be equities or fixed income or whatever, have been, the really big players like Citadel. Now there's no reason why retail can't participate in that and earn yields from making markets. And we can be doing this 24/7. Functionalities there. They can be using the collateral to, to do other things. And then, I guess what I'm saying is it's a new world.
Yeah. So I mean, Citadel, just touching on them, like that from memory, like the most profitable fund in the world, right? So does this tell us that democratizing access to that using this technology will kind of give them their internet moment in financial services? Is that what we're seeing play out here? And then I'll flip that into what does that mean to the future of fund managers? Is 2 and 20 dead? Like where are we going from traditional fee structures, if cost comes out and the market structure, which we'll touch on in a minute, changes and the cost to serve changes under these models, are consumers just getting a better deal? Are we seeing more automated, market structures? What are we thinking there?
Yeah, absolutely. So, just the first part of your question, the citadels, the price makers, investors, retail investors, mums and dads, they're going to be able to invest in bots, AI bots. That does the same thing. They're going to be able to, generate their own yield. The big fund managers, having a monopoly over it is a thing of the past. The whole ecosystem is changing. In terms of what is the role of the investment manager going forward, that is an interesting question, and it depends on the jurisdiction. But let me talk about Australia just for a moment. We have like the setup here in Australia is that a investment manager that runs funds under his umbrella has to be licensed. Okay, and that license usually comes from a trustee. Okay, and the trustee will hold what is called an AFSL, Australian Financial Services License, that is issued from ASIC. Okay, what will happen in the future is that we will have a automated process within tokenization. Okay, so what that means is that the trustee will make a secondary market bid and offer in the fund's shares or the fund's NAV, and that'll go up and down with the market. Okay, so investors can come in, buy in, or sell out 24/7 when they like, and the trustee makes the bid and the offer. Okay, so then what happens from that point? So the investment manager, traditionally, he would have executed. If you buy shares or units in a particular fund, he would manually go out there and execute that. What will happen in the future is that the trustee will have automated that flow. It'll be a smart execution, whether it be through an aggregator that aggregates all of the centralized exchanges liquidity, or all the decentralized exchanges liquidity, or both. Okay, that will be smart. It'll be a smart execution by the trustee. Okay, so now you're starting to see a change in the dynamics. Firstly, you're seeing the trustee set the bid-offer spread, okay, in the secondary market. That will come from them. Yes, there'll be a communication between the investment manager and the trustee, but the trustee will have the power. The trustee will also have the power to execute. Okay, so in the future, the investment manager will sell the fund to everybody, that they can sell to, and then they will be the one that is working on on whatever their strategy is. Okay, so they really won't have to deploy resources on execution and back office and things like that in the future. Trustee also will codify the administrator to save costs. So you will not have an independent administrator. Everything will be part of the code. Okay, and we're working at the moment with Redbelly and Liquidize, especially Liquidize on that point, to codify the administrator. Eventually what will happen is the auditor will be codified. Okay, and so everyone who's out there, you get a sense that the costs of running a fund are going to be reduced significantly, and the control or a lot of the power will go to the trustee. So there's going to be a big change in the future, and that's how it's run in Australia. That's not how it's run offshore. It's because we have a licensing regime like it is. Okay, and there's a big opportunity in that.
I think it's interesting. So your point about code, I hadn't thought about the upstream benefits of codifying the rules. It means you audit the rules, not the transactions or the process, right? Like by having that codified. So audit costs, like I can see you're right, a dramatic reduction in funds cost. Does that then mean the ticket sizes or the scalability? Are we going to see trillions of dollars in BlackRocks into the future, or are we going to see more individual trading strategies picked up by AI agents to your point, rotate and rebalance based on market conditions? Am I going to have my own analyst or broker that'll manage across that? How do you think the macro? I mean, if you look at the passive money in the ETF structures today, and arguably maybe the ASX 200 here, or maybe the Nasdaq 100 or S&P 500 is potentially overbid or overbought because all this passive money arrives in those stocks in a way. And that's had a pretty profound impact on how the capital market works and how funding costs for those things work. I think the Nasdaq's at 35 times earnings or something at the moment. Does this macroly change how capital is distributed, access to capital? How do you think that plays out in the context of AI and fund and capital structure? So I know this.
I still believe that we were going to have passive structures. We will still have single unit trusts, for instance. We will still have passive ETFs, but it can be a passive fund, and then there can be active funds. But really it'll come down to the cost structure, because a lot of the the larger allocations are looking at costs, and those cost structure on the fund level, both on passive and active, can come right down, and they can definitely compete with the ETFs. There's no doubt about it. ETFs are, think about them. They're really a defunct structure, because it is only in business hours. And if you look at the ETF on the ASX, you really do have limited business hours. And then you've got holidays and you've got all sorts of stuff. So if you really had a sense about your risk management, you would not be investing in an ETF.
Amazing. So
there's just one thing. Sorry, there was a slither of what you touched in that question I just want to come back to, and that is the trustee having to take account of liquidity for massive flows. So you can imagine you get a $1 billion flow into a fund on the weekend. Okay, and the trustee is making a bid offer. How to handle that flow? So the trustee in the future will, and together with the investment manager in that particular instance, will have to have it. It will really be a high level, order. So there is so much to consider in automating that flow, from a liquidity perspective, not just on the weekends, but during the week. Small flows, medium flows, big flows. There's a lot of consideration to be given.
Amazing. I'm just looking at the time, and I don't want to tie you up too much. You've got trades to make, but I'm thinking just finally to get a little bit specific. You've touched on a bunch of things that you're working with us on, and our partner Liquidize, in effectively codifying the trustee, I think is how you describe that, with a view of reducing the cost to serve. And I mean, on that point, I think you mentioned Franklin Templeton earlier. I think they've put out a number like $200 million annually of cost that comes out of their business through initiatives like tokenization. So that when you understand the orders of magnitude that are associated, that is a pretty big deal, right? So once we've got, so you're working as both TAF Capital and as JellyC to trailblaze, frankly, in Australia. One, you're working with a stablecoin to be able to subscribe and redeem on rails. You're working with us around identification, AML, CTF, all of your licensing obligations that you have. Is the trustee or is the fund manager, or probably a combination of both, I imagine? And then obviously you've then got the tokenization value proposition on top. What's your kind of time frame and thinking and order of operation as to where you see the opportunities and most important things for you to be working on, and any timeframes you're happy to share with us? Yeah,
absolutely. So we want to tokenize one of our funds, in the next few months. Okay, so we're working on the infrastructure fund, which is a Australian unit trust here. We want to have that tokenized. What we could potentially do, and I was thinking about this overnight, is we could, even in the next 4 to 6 weeks, we could potentially bucket all of our Redbelly that we hold in a number of different entities, into a unit trust and tokenize that and automate the entry and the exit as being a proof of concept. Tokenizing an active fund like the infrastructure fund, there is intricacies in automating, the execution of that strategy. So there's another level. It's not just codifying the administration duties and, for instance, the audit duties. It is codifying the automated execution. So, i.e., going out and buying our portfolio, putting it to work, staking it, whether it be liquid staking or running nodes, etc. Okay, and managing the liquidity from that. There's intricacies there, that are it's going to take us some time, to work through. Single unit trust, like having a Redbelly trust, or another one that we would do would be a bit and saw trust. Okay, a little bit like, for instance, Grayscale. Grayscale was it was a leader in the industry when it bought Bitcoin around $100 and helped drive that up to 1,000. Okay, and then they opened up other single unit trusts. Okay, what we're talking about doing is doing exactly the same thing with what we see as being really great opportunities. Aussie unit trusts, tokenized. Grayscale are not at the tokenized level, and they're doing it in US dollar trusts. We would have Aussie trusts, and it would be tokenized, and then we could do it for US dollar trusts, if the demand was there.
Effectively, you're saying registry back first, and then kind of automated trading strategies, if for lack of a better word, as a future stage, right? So get
anyone can tokenize a registry. Anyone can tokenize, shares or anything like that. It's easy. It is, building the administrative duties into, a live NAV, and then it is building the execution of those units and putting it to work. That is the skill.
That's really insightful, because I think when we look at the real world asset space more generally, and people are sometimes quite frustrated at the pace at which this transformation of this opportunity that is kind of well understood now is taking so long. I guess we're not thinking about, or we're generally thinking about this the tech side of that, not even the regulatory side of that. Are you seeing any challenges from the regulators on using new technology to do these things differently, or are you working inside? Are you kind of working the technology inside the rules that exist?
Yeah, it's a good question. Just going back to your previous question on the timeline, within 12 months, we do want to have all three of our funds tokenized, and we want to have a definitive number of single unit trusts. And then we want to be, working on, our Athena, like we discussed, and rolling that out into, a lot of different, areas. In answer to your question you just asked, yes, we're working with ASIC. A lot of the stuff that we're doing has not been done in Australia. So, writing a offer document for tokenization is something new. Setting the boundaries for, for what's viable from, a KYC perspective. Within the trustee and the funds is something which we're working with you guys obviously on. There's keeping within a regulated framework, i.e., if we're interacting with Redbelly, we only can have the wholesale investors within Redbelly interacting with our funds, for instance. Okay, so making sure that we have that coded into the transfer of the units. For instance, ASIC, one of the questions they have when we last spoke to them was, how are you going to manage weekend liquidity? If you're investing in a deposit, how are you going to give liquidity to investors on the weekend? We're trying to solve that. That's exactly what we're doing with Franklin Templeton. So, I guess the answer is we're working alongside them. Really, they are doing their best. ASIC's doing their best because there is not a framework. It hasn't been legislated yet. The Digital Act hasn't come in. They're doing their best in terms of trying to help, companies like us navigate.
Excellent. So the Digital Act is our Genesis moment or genius moment. What's the so you're just preparing for that moment? Or
we're trying to get everything ready, have done proof of concept, be operational, and we will go live before we have a framework. But we will communicate with ASIC. This is what we're doing. If they have any misgivings or any advice for us, we'll take it on board. If we find that we have a roadblock here in Australia, we will tokenize our funds in the Caymans.
Okay, amazing. Again, I love the entrepreneurial approach to this, but as I said at the top of the call, I'm super excited to be partnering with someone that can straddle both the vision of the future of what it should look like and also be open-minded and collaborative with us at Redbelly around verifiable credentials, particularly. You mentioned a moment ago the wholesale sophisticated investor check and that complex eligibility criteria is exactly what we've designed for. And as you said, we're implementing things like zero knowledge, which trying to explain that to a regulator is a few meetings, let's say, and then getting everyone comfortable with the way forward is a process. But I think once we tip over, as you said, we're really off to the next generation of financial services. Michael, last opportunity to say anything before I let you get back to the important work, because we need to ship that TVL on Redbelly. So I better let's get back to the growing it. Anything you want to share before I let you go?
Well, I guess what I'd say is the first step before everything opening up here in Australia is getting a liquid Aussie dollar stablecoin. Okay, we have the framework for everything to work because we've got Redbelly and all of the beautiful things that Redbelly's doing, from having one of the fastest networks, if not the fastest network in the world, to KYC on entry, working at the Genesis level with CSIRO, partnering with good people, part of the Project Acacia. Really bringing the institutional members along with it. We're there. We're ready to go. It's now the train has left the station. It's just starting, but I'm really excited about the trip ahead, and it's going to be a fantastic ride. Amazing. By the end of it, 1-2 years down the track, I'm sure we'll look back on this interview and go, do you know what? The actual reality now, we've progressed so much quicker than what we could have ever imagined.
Amazing. Thank you so much for your time and your partnership and collaboration with Redbelly. We're really excited about what you're doing, and we think the opportunity to democratize the whole asset class, the whole capital market. And as you said, we'll have a whole other podcast on AI and what that opportunity means in democratizing access to these products that people don't understand, or democratizing financial literacy, if you like, versus access to the markets. But appreciate your insights, super insightful. I love the fact that you can see both sides so clearly, and that's what's going to, no doubt, make your portfolio super successful. So thanks again, and we'll speak again soon. Thanks, Michael.
Good on you, Alan. Thanks very much for having us, and goodbye to all of the Redbelly community.
Thanks, Michael.
There you go, folks. That was a treat indeed. A lot of insights there from both Alan and Michael, and it was really interesting to see just how they're piecing things together and moving forward in the funds management space, their outlook on investments and why they decided to tokenize. If you want to get in touch with all of them, we'll put those details in the show notes below. And please do stay around for looking at the previous Redbelly Insights episodes. In episode 6, we had a treat with Fireblocks and looking looking at how they do data and digital custody, digital asset custody, MetaWealth before that, Raise, Ferox, Bluebird, and others. A whole lot more coming and a whole lot behind us. So there's a ton of information out there. Make sure to check out the AMA page on Redbelly for all of this, and also on YouTube and Twitter if you're watching there. We'll see you in the social